Wall Street hasn't seen a rally like this in decades. In just 1 year, a handful of US tech companies added over $5 trillion in market value, lifting everything from the S&P 500 to household retirement accounts. The engine behind it all? Artificial intelligence. From chip makers like NVIDIA and AMD to software giants like Microsoft, Apple, and Amazon. AI has become the word that moves markets. But here's the real question. Is this growth or is it a bubble? And how long can it last before something gives? Let's dive into the story behind America's $5 trillion AI wealth surge. Who's winning, who's at risk, and what this means for the future of tech, business, and your portfolio. It started quietly with OpenAI's ChatGPT in late 2022. That single product redefined what AI could do for business. It sparked something in Silicon Valley that rippled across the entire economy. Within months, every company, from Google to Walmart, was trying to figure out its AI strategy. Investors took notice. By 2024, the Magnificent Seven, NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, and Tesla were responsible for nearly 2/3 of the S&P 500's total gains. And in 2025, according to JP Morgan, about $5 trillion in new household wealth was created just from these AI-linked stocks. That means millions of Americans became richer without even realizing it through their 401ks, index funds, and pensions that hold slices of big tech. So, who's driving this? Let's start with NVIDIA, the clear poster child of the AI era. Its chips power every large language model, every AI data center, every training cluster on the planet. Its revenue tripled year over year, profits exploded, and Wall Street treated the company like it had discovered electricity itself. Then came Microsoft, embedding AI into everything: Word, Excel, Outlook, Azure. It wasn't just building AI tools, it was building an AI platform that millions of companies depend on. Apple, meanwhile, took a quieter route, focusing on on-device AI and its long-term vision of merging intelligence with hardware. Amazon turned its cloud division, AWS, into a machine learning infrastructure powerhouse. And Meta went all in on AI after its metaverse ambitions fell flat, now building open-source AI models that rival OpenAI itself. Each of these moves reinforced the same belief that AI isn't a product, it's an era. An era where data, algorithms, and computing power replace traditional capital. But beneath the excitement, there's an uncomfortable truth. Valuations are now stretching far beyond historic norms. NVIDIA trades at price-to-earnings ratios higher than Apple's during the iPhone boom. Microsoft's market cap has crossed $3 trillion. And investors are pouring money into AI-themed ETFs, many of which include companies that barely touch AI at all. Sound familiar? It should. It's the same pattern we saw during the dot-com bubble, when every company that added .com to its name saw its stock triple overnight. Back then, investors bet on potential. Now, they're betting on compute. Yet, here's where it gets more interesting. Unlike the early 2000s, today's AI surge is built on real demand. Corporations are spending billions on GPUs, AI software, and data infrastructure. Governments are investing in AI education and cloud capacity. And every Fortune 500 company now has an AI initiative, no matter how small. This isn't speculative hype, it's structural transformation. Still, the market is behaving as if there's no ceiling. Investors are pricing AI as though it's going to rewrite every industry overnight. Healthcare, finance, retail, even energy. And while that might eventually happen, history tells us that revolutions take time and often go through painful corrections. Let's break this $5 trillion boom into three forces. First, the hardware wave. NVIDIA, AMD, and Taiwan's TSMC are riding the AI hardware arms race. Every company building AI models needs chips, and there aren't enough to go around. That scarcity drives prices, profits, and investor euphoria. Second, the software integration wave. Microsoft's Copilot, Google's Gemini, Adobe's Firefly. These aren't one-off tools. They're recurring revenue machines. Each integration makes existing products more valuable without creating entirely new categories. Third, the infrastructure wave. Data centers are multiplying at record speed. Meta, Amazon, and Oracle are spending billions to expand cloud capacity. Even energy utilities are rethinking their grid capacity just to power the AI explosion. So, this isn't just about stock prices. It's about reshaping the physical and digital backbone of the economy. But what happens next? Analysts are split. Some argue the AI boom is just getting started, that we're in the equivalent of the early iPhone days, when only a fraction of potential use cases were known. They say AI will create trillions in new productivity, and the companies leading it deserve their sky-high valuations. Others warn that the hype has run too far. They point out that AI adoption among businesses is still below 10%, according to recent studies. Many pilot projects haven't yet shown measurable ROI. And power consumption, regulation, and competition could slow the march toward profitability. In other words, the dream is real, but the timeline might not be. The next 12 months will be critical. We'll see if companies like NVIDIA can maintain their growth once supply catches up. We'll see if AI startups can survive after venture capital tightens. And we'll see whether big tech can turn AI from a cost center into a consistent cash generator. Because right now, AI is expensive. Training large models costs tens of millions of dollars, and running them costs millions more every month. For AI to truly justify its valuations, it needs to save money, not just spend it. That's the pivot investors are waiting for. So, what does this mean for business leaders and regular people? If you're a company executive, the AI boom isn't just a Wall Street story. It's your competitive pressure. Your suppliers, your partners, your customers, they're all getting smarter, faster, and more efficient through AI. Not adopting it isn't a neutral choice anymore. It's a disadvantage. If you're an investor, the key is discernment. Not every AI stock is created equal. Look for companies with real revenue tied to AI products, not just marketing promises. History rewards those who separate innovation from imitation. And if you're just an observer, remember this. Every technological revolution, electricity, the internet, the smartphone, starts with excitement, then consolidation, then transformation. AI is following that exact same script. The $5 trillion wealth surge shows how much faith America has placed in artificial intelligence. It's driving markets, defining corporate strategy, and reshaping global competition. But faith alone doesn't sustain revolutions. Execution does. So, whether this ends in a correction or a golden age will depend on one thing. Can AI actually deliver real-world productivity at the scale investors are betting on? If it can, this might be just the beginning of the most profitable era in tech history. If it can't, then $5 trillion might be the cost of learning that hype always comes before reality.